Hello everyone. Today we're going to analyze one of the key indicators of the US stock market. This is the Nasdaq 100 index. It includes the 100 largest technology companies on the American stock market. And in the near future, I'll try to record short reviews on Bitcoin, the S&P 500 index, and Ethereum. That's another reason to subscribe to the channel if you haven't already, or to hit the bell if you forgot to do so. Now let's move on to the chart. And in front of us is not the Nasdaq index chart, but the Bitcoin chart. Just a couple of words about it. In the previous review, I mentioned what I'm expecting. A rise to the area of $100,000 to $102,000. And today's decline in no way cancels out this scenario. This scenario will only be invalidated if we see the weekly candle close below the red 100-week moving average. And then there will be questions about whether growth will continue to the area of 100,000. For now, it all looks like a wide-ranging flat movement, with a priority of moving into the area of $100,000 to $102,000, where the 50-week moving average is located. Could it go higher? Yes, it could, but we can't know for sure. For now, the priority is this area. Now let's find the Nasdaq index here using the search on the QuantFury platform. You can see that the shares of the exchange itself are also traded here. Nasdaq, as well as futures and mini contracts, but we won't be looking at them here. Why? Because these are specific futures with a set start date and end date, the expiration date. Here, for example, it says that their trading will end in 7 days, 2 hours, and 41 minutes. We need a longer term chart, so we'll switch to TradingView. But you can also trade futures and mini contracts here in QuantFury. Now we have the chart. It's a long-term chart, these are monthly candles, and here I want to highlight a few key points. This is still the Nasdaq index. The first point is right here, where we broke through the 200-month moving average. Here too, we broke through the 200-month moving average. And after that, we only tested the 50-month moving average once. What are these moments? This is the so-called crisis, the crisis of internet companies, the dot-com crisis. And this is the mortgage crisis of 2007 to 2009. And here the decline was due to the fact that the Federal Reserve was tightening its monetary policy and announced that it would raise the interest rate at least 3 times during the year. The correction was quite significant, about 30%, but nevertheless, as you can see, it did not reach either the 100-month or the 200-month moving average. Also note that during the dot-com crisis, there was a drop to around the 30 level on the RSI. Yes, the indicator didn't quite reach those values, but it was close. And during the mortgage crisis, we actually did reach that lower boundary. Since 2009, essentially, there hasn't been a single crisis. Because this decline that we saw in 2021 and 2022, ordinary people didn't really feel it. No one was shouting disaster, disaster. It was only noticed by traders. For the most part, regular people didn't really experience it. And now let's move directly to the current phase of the market. Note that we continue to hit new all-time highs, but last month, November, closed with a red candle. The problem is that in November, the index did not reach a new all-time high. It was last updated in October. And such a structure is not very reliable for a reversal. That's why I assume I allow for the possibility that we will see growth with a new all-time high. And only after that, perhaps, there will be a decline. But right now, it's too early to talk about a decline for 2 reasons. First, one red candle is not enough. We need to see a bearish engulfing pattern. It's not here. Secondly, notice that right here at this point we had some kind of all-time high. And here there was some kind of RSI high. Here is the new all-time high. A new RSI high. What's happening? They are rising in sync, meaning everything is harmonious, synergistic, and this means that the current growth is normal. Yes, there are no anomalies here in the form of divergence, which means we should wait. Yes, the situation is critical, it's on the edge, but for now this is not a short from the perspective of the monthly candles. Now let's remove everything we've drawn and switch to the weekly candles. What do we see on the weekly time frame? Here we see, and we mentioned this in one of our previous reviews, though it was about the S&P 500 index, we see, well, a similar picture, that we had a bearish pattern. An engulfing pattern which indicated that the decline would continue. And it did continue, but pay attention, this was last week, not the current one. We have formed a reversal, and now the situation is shaping up where we might update the all-time high. That is, for example, the price could come up here, a bit higher, while the RSI could come down here, relatively lower, compared to this high. And here, on the weekly time frame, we could get a divergence, but for that, we need to update the high. Moreover, the bullish engulfing pattern on the weekly candles indicates that the trend has locally reversed upward. No matter how high the price may seem to you, whether it's the S&P 500 index, Nasdaq, or any other, you need to work based on real structures. And here, the structures are bullish at the moment, despite the market being extremely overheated. So, there is no short position here either. What suggests itself is a move toward a new all-time high, or at least an approach to the existing one. In other words, to the area of 26,160 points. That's roughly how it looks. Now once again, let's clear everything and switch to the daily candles. What do we see on the daily candles? We see that some kind of correction has taken place. You can't say that it was particularly small. It reached the 100-day moving average, but note that even in April, we went significantly below the 200-day average. And now we're once again above all the moving averages. This huge bearish candle from November 20th has been completely absorbed. And here too, the situation favors going long. Is it possible to buy at the current levels? Honestly, I wouldn't do that. I would wait for a divergence to form. A bearish engulfing pattern on the daily, or even better, on the weekly candles against the backdrop of a divergence. And then I would open a short position, but right now there's no reason to buy the market near its all-time highs. But for that, you either have to be very well informed or a very risky person. I am neither, so I suggest waiting. Subscribe to the channel if you enjoy these kinds of reviews. It makes me happy to see my audience grow, and I'll do my best to provide you with quality analysis. As I mentioned, the next reviews will be on Bitcoin, the S&P 500, and Ethereum. Goodbye.